Investing is often presented as a straightforward path to financial independence. Many people are told that if they simply buy stocks, hold them for long enough, and remain patient, wealth will eventually accumulate. While long-term investing can indeed create substantial financial growth, the reality of the financial markets is far more complex than this simplified narrative suggests. Beneath the surface of rising stock indices and optimistic headlines lies a series of hidden risks that many investors either underestimate or fail to recognize altogether. The most dangerous aspect of these risks is not that they exist, but that they are frequently ignored. Many investors assume that diversification alone eliminates risk, or that simply holding investments for the long term guarantees positive outcomes. In reality, even experienced investors can fall victim to structural market risks, behavioral biases, and economic forces that are not immediately visible. Understanding these hidden risks is not about discouraging investment. Instead, it is about recognizing the forces that shape financial markets and learning how to protect capital while still pursuing growth. Successful investors are not simply those who chase the highest returns, but those who carefully manage risk while allowing their investments to compound over time. Let's explore some of the most overlooked risks in modern investing and how disciplined investors can avoid them. The illusion of diversification. Diversification is one of the most widely repeated principles in finance. The concept appears simple. By spreading investments across multiple assets, investors reduce the chance that one poor-performing investment will damage their entire portfolio. While diversification does reduce certain types of risk, many investors misunderstand how limited its protection can sometimes be. One common mistake is believing that owning many stocks automatically creates diversification. In reality, if those companies operate within the same sector or respond to similar economic conditions, they may move in the same direction during market stress. For example, technology companies may perform strongly during periods of innovation and economic growth, but they can also decline simultaneously during interest rate increases or economic slowdowns. Another issue arises when investors believe that holding multiple funds ensures diversification. Many exchange-traded funds and mutual funds contain overlapping holdings. An investor may unknowingly hold the same large companies through multiple funds, creating a portfolio that is far more concentrated than it appears. True diversification requires exposure to different asset classes, industries, geographic regions, and economic drivers. Stocks, bonds, commodities, and real estate often respond differently to changing economic conditions. By carefully balancing these assets, investors can reduce the likelihood that a single economic event will severely damage their portfolio. Diversification is not about owning many investments, it is about owning investments that behave differently under different circumstances. Market timing and the cost of missing key days. One of the most persistent temptations in investing is the desire to predict short-term market movements. Investors often believe they can avoid losses by selling during downturns and buying again once markets begin to recover. In theory, this strategy appears logical. In practice, it is extremely difficult to execute successfully. Financial markets often move unpredictably. Some of the strongest market gains occur during periods of extreme uncertainty. Investors who attempt to exit markets during volatility frequently miss the early stages of recovery, which can significantly reduce long-term returns. Studies of historical market performance show that missing just a handful of the best trading days over several decades can dramatically reduce an investor's total return. These powerful recovery days often occur when sentiment remains negative, meaning many investors are still waiting on the sidelines. The challenge is that no one can consistently predict when these moments will occur. Even professional fund managers struggle to time markets effectively. For this reason, many experienced investors focus on maintaining long-term positions rather than attempting to move in and out of the market. Avoiding the temptation to time the market requires discipline and patience. Instead of reacting emotionally to short-term fluctuations, successful investors focus on long-term economic growth and the underlying strength of the businesses they own. Inflation and the silent erosion of wealth. Inflation is one of the most underestimated risks in investing. While market volatility receives constant attention in financial news, the gradual erosion of purchasing power often goes unnoticed. Inflation occurs when the general level of prices rises across an economy. When this happens, each unit of currency buys fewer goods and services. Even moderate inflation can significantly reduce the real value of savings over time. For example, if inflation averages 3% per year, the purchasing power of money can decline substantially over several decades. Investors who hold large amounts of cash or low-yield investments may find that their wealth appears stable in nominal terms, but has actually declined in real terms. Certain assets historically perform better during inflationary periods. Equities, real estate, and commodities can sometimes benefit from rising prices because companies may increase revenues while property values adjust with inflation. However, inflation can also create challenges for financial markets. Rising inflation often leads central banks to increase interest rates, which can reduce stock valuations and slow economic growth. Investors who understand inflation recognize the importance of maintaining assets that can grow faster than the rate of rising prices. Protecting purchasing power is just as important as generating returns. Overconfidence and behavioral biases. Human psychology plays a powerful role in financial decision-making. Many investors assume that financial markets operate purely on economic data and rational analysis. In reality, investor behavior frequently influences market movements in significant ways. One of the most common behavioral risks is overconfidence. After experiencing several successful investments, individuals may begin to believe that their success is primarily the result of skill rather than favorable market conditions. This confidence can lead investors to take increasingly large risks or abandon diversification strategies. Another behavioral challenge is herd mentality. Investors often feel more comfortable making decisions that align with the majority of market participants. Experienced investors recognize that managing their own emotions is just as important as analyzing financial data. Establishing clear investment plans, maintaining long-term perspectives, and avoiding impulsive decisions can significantly reduce behavioral risk. Liquidity risk and market stress. Liquidity refers to the ability to buy or sell an asset quickly without significantly affecting its price. Many investors assume that financial markets are always liquid, particularly when dealing with widely traded securities such as stocks or exchange-traded funds. Liquidity risk is particularly relevant for investments such as small-cap stocks, certain bonds, and private assets. During market disruptions, these investments may become difficult to trade efficiently. Even large markets can experience liquidity problems during severe economic crises. During financial shocks, investors often rush to sell assets simultaneously, overwhelming normal market mechanisms. Interest rates and valuation risk. Interest rates play a fundamental role in determining the value of financial assets. When interest rates change, they influence borrowing costs, corporate profitability, consumer spending, and investment behavior. Low interest rates tend to support higher stock valuations because investors are willing to accept lower returns when safe investments yield very little. Conversely, when central banks raise interest rates, investors often demand higher returns from stocks and other risk assets. This shift can lead to declines in equity valuations, particularly in sectors that rely heavily on future growth expectations. Technology companies, for example, often experience significant valuation adjustments during periods of rising interest rates. Bond markets are also highly sensitive to interest rate movements. When rates rise, the prices of existing bonds typically fall because new bonds offer higher yields. In the end, investing is not simply about finding the next profitable opportunity. It is about understanding the environment in which wealth grows and protecting capital from the risks that many people fail to see. Those who learn to recognize these hidden forces are the ones who position themselves for lasting financial success.